95% of the trading journals sitting on hard drives right now are almost useless. Not because people aren't filling them out, because they're filled with the wrong trades. Screenshot the winner, write a proud paragraph, move on, and skip the one trade in the entire session that actually had something to teach. That's the exact mechanism this video is going to take apart. Not keep a trading journal, which you've heard 1,000 times and probably already have to. The specific, almost counterintuitive reason that a journal built around your losing trades will teach you more in 3 months than a journal built around your winning trades will teach you in 3 years. And why almost every trader does the opposite without ever noticing they're doing it. Think about how every other field that studies failure for a living actually operates. Airlines investigate crashes in obsessive detail and barely study the millions of flights that land safely, because a safe landing confirms almost nothing specific. It's the expected outcome of thousands of things going right, none of which get isolated by the fact that they worked. A crash isolates exactly one thing, the point where the chain of events broke. Quality control engineers on a factory floor pull the defective units off the line and take them apart. They don't spend their afternoons disassembling the units that passed inspection, because a working unit doesn't tell you anything you didn't already assume. Trading is the only skill-based discipline where huge numbers of practitioners build their entire self-improvement practice around studying the outcomes that already confirm what they wanted to believe, while quietly avoiding the outcomes that would actually tell them something new. You probably already journal, at least loosely. Most traders who've been at this more than a year do. Screenshots of good trades, a note about what worked, maybe a running tally of your best setups. It feels like diligence. It looks like the behavior of someone taking this seriously, and it is almost completely useless, for a reason that has nothing to do with effort and everything to do with what a winning trade is actually capable of teaching you. Here's the uncomfortable mechanism underneath all of it. A winning trade tells you that a sequence of decisions was followed by a good outcome. It does not tell you whether those decisions caused the outcome, or whether the outcome happened for entirely unrelated reasons and your process was irrelevant, or even actively wrong, riding along on top of a market move that would have made almost any decision look good that day. A losing trade, on the other hand, forces a much more specific question. Exactly where, in this sequence, did things diverge from what should have happened? Wins are ambiguous. Losses are diagnostic. And almost every trader spends their journaling energy on the ambiguous data instead of the diagnostic data, because the ambiguous data feels better to look at. Let me introduce you to two traders. Call them James and Sarah. James keeps what looks from the outside like an excellent trading journal. Every winning trade gets a screenshot, a paragraph on what he saw, and a note on which part of his process to keep doing. Over 18 months, this journal grows into a genuinely impressive-looking document. Dozens of annotated winners, a running highlight reel of his best reads on price action. He rarely writes about losing trades in any real detail, partly because it's uncomfortable, and partly because, in his own words, there's not much to learn from a loss. Sometimes the market just does what it does. His win rate over that stretch sits around 52%, which is fine, not remarkable. There's a specific entry in James's journal from month 11 that captures the whole problem. He takes a trade 9 minutes before a central bank rate announcement, gets stopped out almost immediately when volatility spikes, and the journal entry for that day simply reads, "Rough one, market got choppy around the news, nothing really to fix here, just bad luck." 3 weeks later, nearly the identical situation happens again. Same kind of setup, same proximity to a scheduled release, same result. That entry reads almost identically to the first one. He never connects the two, because he never goes back and reads his losing entries as a set. Each one, examined alone, genuinely does look like isolated bad luck. It's only when you pull every losing entry from those 18 months and lay them side by side that the pattern becomes undeniable. But that's an exercise James's journal was never designed to support, because his journal was built to make wins feel good, not to make losses legible as a group. What's not fine is that his losing trades, when you actually go back and look at them as a batch, cluster overwhelmingly around a single pattern. Entries taken in the last 20 minutes before a major economic release, a window. His own written plan explicitly tells him to avoid. Because he never studied his losses closely enough to notice the cluster, he keeps making the same avoidable mistake for a year and a half. Protected the entire time by a journal that only ever showed him what he was doing right. Sarah's journal looks almost embarrassing by comparison. It's thin on wins. A single line, usually just worked as planned, size followed, exit followed. But every losing trade gets a full page. What was the setup? What did the plan say to do? What did she actually do? Where? Specifically, did the two diverge, if they diverged at all? Sometimes the answer is simply the setup was valid and the trade still lost. No execution error. And she writes that down too, because a clean loss with no process breakdown is itself useful information, proof that not every loss needs fixing. Her entries aren't long because she's punishing herself. They're long because she's genuinely curious, the way an investigator is curious rather than the way someone doing penance is dutiful. A typical entry from month 6 reads through the exact sequence. Entered on the retest of a prior high, sized correctly at her fixed percentage, price reversed almost immediately, she held to her preset stop and exited exactly there. No deviation anywhere in the sequence. Conclusion: clean loss, no correction needed, strategy performing within its known variance. That single page took her 4 minutes to write and told her, with total clarity, that this particular loss required no behavior change at all. A conclusion James's journal was never structured to let him reach with any confidence, because he'd never built the habit of checking for divergence in the first place. 8 months in, a pattern she'd never have found in her wins shows up clearly in her losses. Nearly 40% of her losing trades happen on setups taken within the first 15 minutes of the session open. A window where her specific strategy, it turns out, has a real and consistent disadvantage. She doesn't need a bigger sample of wins to find this. She needs a well-examined sample of losses, because the losses were where the pattern was actually visible, not because Sarah is more talented than James, because she pointed her journal at the data that was actually capable of teaching her something, instead of the data that felt good to review. That's the whole video, and everything else is explaining exactly why almost everyone builds the wrong kind of journal without realizing it. Root cause number 1. Wins feel like confirmation, and confirmation feels like learning, even when it isn't. Every time a winning trade gets journaled with a note like, good read, trust the process, the brain files that away as validated knowledge. But a single win validates almost nothing statistically. It's one data point in a process that might have a real edge, might have no edge at all, or might even have a negative edge that got lucky once. Reviewing wins feels productive because it produces a pleasant emotional payoff. It rarely produces an actual correction because there's usually nothing in a win that needs correcting, which means there's nothing for the journal entry to actually do except make the trader feel good about a decision that may or may not have deserved the credit it's getting. Root cause number 2. Losses trigger avoidance, and avoidance masquerades as moving on. Nobody enjoys sitting with a losing trade in detail. It's uncomfortable, sometimes embarrassing, occasionally an indictment of a decision made under real pressure. The natural response is to glance at it, absorb the dollar amount, and move forward, telling yourself there's nothing more to learn, because dwelling on it won't undo the loss. This isn't laziness. It's a completely understandable emotional defense, but it means the exact trades most likely to contain a fixable, repeatable mistake are the ones getting the least scrutiny, purely because scrutinizing them doesn't feel good. Root cause number 3. Outcome and process get conflated in both directions. A win with a flawed process looks, on the surface, identical to a win with a sound process. The account balance goes up either way. A loss with a flawed process looks, on the surface, identical to a loss with a sound process that simply didn't work out that particular time. The account balance goes down either way. If you're only reviewing wins, you have no mechanism for catching the flawed process wins, because the outcome is masking the problem. Imagine a trader who sizes up impulsively out of frustration, after a losing streak, catches a lucky move and books a big win. If that win goes into the journal with a note like, "Great instinct to press here," the journal has just permanently recorded a dangerous impulse as a skill worth repeating. If you're carefully reviewing losses, you at least have a chance of separating "this was a mistake" from "this was a correctly executed trade that happened to lose," which is information you can never extract from a winning trade at all. Root cause number 4. Small sample bias hides in wins more easily than it hides in losses. When James notices 2 or 3 winning trades that share a similar setup, he tends to generalize quickly. This pattern works, filed as a rule. When a trader actually forces themselves to sit with losses in detail, the smaller sample size of any single losing cluster becomes harder to ignore, because the discomfort of the loss makes you look closer rather than skim past it. Sarah's 40% cluster in the opening 15 minutes only became visible because she was already in the habit of examining losses individually, instead of glancing at an aggregate win rate and calling it good enough. Root cause number 5. Journaling wins reinforces identity, and journaling losses threatens it. So most people unconsciously build the version of the journal that feels safer. A trader who reviews mostly wins gets to think of themselves as someone who reads the market well, someone whose instincts are basically sound. A trader who reviews losses in detail has to sit with the version of themselves that makes mistakes, misreads setups, occasionally breaks their own rules under pressure. Nobody chooses the second version on purpose, most of the time. It gets avoided quietly, one skipped journal entry at a time, until 18 months have passed, and the pattern hiding in the losses has never once been looked at directly. Now here's what actually replaces the win-focused journal. Because journal your losses more isn't specific enough to actually change behavior on a rough day when the last thing you want to do is relive a bad trade. Shift 1. Make the loss entry mandatory and the win entry optional. Flip James's structure entirely. Every losing trade gets a full entry before you're allowed to close the platform for the day. Setup, plan, actual execution, and the specific point of divergence if one exists. Winning trades get a single line unless something about the win genuinely surprised you. This isn't about ignoring wins, it's about routing your limited daily journaling energy toward the trades that actually contain a correctable signal. Shift 2. Separate mistake losses from clean losses explicitly, every time. Every losing trade needs one of 2 labels attached before the entry is considered complete. Either this was a process breakdown, a rule broken, a size ignored, an entry taken outside the plan, or this was a clean loss, executed exactly as designed. That simply didn't work this time. This single labeling habit does more to accelerate improvement than almost anything else in this video, because it stops you from either beating yourself up over clean losses that needed no fixing or ignoring mistake losses that desperately did. Shift 3. Review losses in batches monthly, not just individually in the moment. A single loss reviewed in isolation rarely reveals a pattern. 10 or 15 losses reviewed together, sorted by time of day, setup type, or market condition, reveal clusters that are invisible, one trade at a time. This is exactly how Sarah found her opening 15 minutes problem. Not from any single loss, which looked unremarkable on its own, but from laying multiple months of mistake and clean labeled losses side by side and noticing where they clumped. Shift 4. Interrogate wins for hidden process errors, not for validation. When you do review a winning trade, the useful question isn't, "What did I do right?" It's, "Did I actually follow my plan, or did I get away with something?" A win taken at double your normal size, or held past your stated target out of greed that happened to pay off, is not a validated process. It's a mistake wearing a disguise, and the only way to catch it is to interrogate wins with the same suspicion you'd apply to a loss, rather than the celebratory tone most journals default to. Shift 5. Track your divergence rate, not just your win rate. Alongside your win percentage, keep a running count of what fraction of your losses were labeled as mistakes versus clean losses. A falling divergence rate over time, fewer and fewer losses caused by actual process breakdowns, is a far more meaningful measure of improvement than win rate alone. Because win rate can rise or fall for reasons that have nothing to do with your discipline, while divergence rate specifically measures whether you're closing the gap between your plan and your actual behavior. Here's the identity shift underneath all of this. Right now, you might think of your trading journal as a scrapbook, a record of the trader you're becoming, built primarily from evidence of the times it worked. That framing quietly steers you toward collecting validation instead of collecting information. The traders who actually improve fastest think of their journal as something closer to a coroner's report. Not a record of triumphs, but a document whose entire purpose is figuring out exactly what went wrong when something did. Because that's the only place a specific, correctable cause is ever sitting in plain view. A coroner doesn't write reports to celebrate the patients who lived. The report exists purely to establish cause, so the same cause can be recognized and prevented next time. When you stop treating your journal as a highlight reel of your good judgment and start treating it as a report built to find the cause of every failure, the whole document starts producing actual behavior change instead of just pleasant memories. And here's the part of this video that's supposed to feel deflating on purpose. If your journal is fun to read back through, it's very likely the wrong kind of journal. A journal built correctly around losses is going to feel a little like paperwork. Mildly uncomfortable, occasionally embarrassing, never a highlight reel you'd want to show anyone. That discomfort is not a sign you're doing it wrong. It's the exact sensation of information actually being extracted from a trade instead of a warm feeling being manufactured from one. This is uncomfortable because most trading content treats journaling as an act of self-encouragement, a place to build confidence, track your wins, remind yourself you're improving. Confidence built that way is fragile because it was never actually tested against the trades most likely to expose a real flaw. Confidence built from carefully labeled, honestly reviewed losses is far more durable because by the time you trust yourself, you've already looked directly at every place you didn't deserve that trust yet and fixed what could be fixed. There's a reason experienced traders often describe a strange kind of relief after a loss gets fully documented and understood. Not because the money came back, but because an unknown risk just became a known and correctable one. And known risks are always easier to carry than the vague, undiagnosed kind sitting quietly in a journal that never looked closely enough to find them. So let's go back to James and Sarah, because that's where this lands. James, after finally sitting down and sorting 18 months of losses by time of day instead of by how they felt to relive, finds the same cluster this video already told you about, a disproportionate share of his losses sitting in the 20 minutes before major releases, exactly where his own plan told him not to trade. He didn't need a new strategy. He needed to stop protecting himself from looking at the data that already existed, sitting untouched in trades he'd been too uncomfortable to examine closely for a year and a half. The fix, once he actually saw the pattern, took him one afternoon to implement. A simple calendar block that stopped him from opening any new position within 30 minutes of a scheduled release. 18 months of an avoidable mistake, solved in an afternoon, the moment the data was finally allowed to speak. Sarah, meanwhile, is still doing exactly what she was doing 8 months ago, writing a single line for her wins and a full page for her losses. Her journal will never make an impressive highlight reel. It has slowly, quietly become the most accurate map of her own weaknesses that exists anywhere, built one uncomfortable page at a time. She's not smarter than James was. She's simply pointed her curiosity at the failures instead of the successes. And the failures, it turns out, were where the actual map was hiding the entire time. So here's the actual choice. And it's binary the same way everything in this framework tends to be. You can keep building a journal that mostly documents the trades that already worked, which feels good and teaches you almost nothing, because a win rarely tells you why it happened. Or you can build the kind of journal a pathologist would recognize, one that shows up specifically for the moments something went wrong, because that is the only place the cause was ever actually visible. The trader who only reviews wins gets to feel good about their process indefinitely, right up until the exact mistake sitting untouched in their losses finally gets expensive enough to notice. The trader who reviews losses gets to feel uncomfortable a little more often and correct a little faster. And that trade, uncomfortable now versus expensive later, is the actual decision hiding inside every journal you'll ever keep.